Hey everyone, Indian stock market has witnessed one of the strongest bull rallies since the COVID lows. This rally is absolutely crazy, especially in the mid-cap and small-cap segment. But the fact is that eventually everything would revert to its mean. So if the market goes up too much and valuation become very high, it will eventually correct. Please note that I'm not trying to scare you here. I'm a firm believer in India's growth story. And I always say that equity market is one of the best asset class to create wealth. However, the problem is greed. If you look at the history of Indian stock market in last 40 years, there have been multiple cases of bull rallies that attracted a lot of new investors. The biggest problem is majority of new investors join the party when it is about to end, and then all they are left with is hangover. Especially in the last few years since COVID, millions of new investors have started their stock market journey. But let me be very honest, very few people actually do the research before investing their money. Majority of them are only looking for quick tips to double their wealth in no time. And that is the recipe of disaster. I always take this example of driving a car. If you don't know how to drive, you might ride the car for a few meters or even a few kilometers, but eventually it would end with an accident. So just like if you want to reach your destination, you must learn how to drive. If you want to create wealth in stock market and achieve your financial goals, you must learn how to study a business before investing your money. And more than anything, you need to learn how to avoid the mistakes, especially during the bull run. Because during the bull rally, every Tom, Dick and Harry is an expert. But as Mr. Warren Buffett says, only when the tide goes down, you discover who has been swimming naked. That's where in this video, I want to focus on some of the common mistakes people end up making during the bull rally. Now it is not that these are new mistakes. Year on year, over the last 40 years, people have ended up making these same mistakes. So if you can learn from those mistakes and can avoid them, it would solve majority of problem. The reason why I'm discussing this is because majority of new investors have entered into the stock market in recent times when the market has already rallied a lot. And when there's a correction and they lose money, they would eventually blame the stock market. On the contrary, if you got your basics right, then correction can actually be a great opportunity to invest your money. So in this video, I want to discuss 5 common mistakes that retail investors end up making in the bull rally. This would be useful especially when you are new to the investment journey and have started post-COVID. Alright, let's get started. So first mistake is falling for FOMO, that is fear of missing out. Due to a strong bull rally, many stocks have generated high returns, especially in the hot themes like power, defense, infra, PSU, railway, capital good, electronics, solar sector and so on. And when you see those stocks consistently going up, it creates FOMO. You feel missed out and want to own those stocks in your portfolio even at higher levels. So you end up making more of an emotional decision rather than a logical one. And honestly speaking, this FOMO is applicable for everyone. Sometimes even I end up getting this FOMO feeling in hot sectors. The question is how to avoid this FOMO. So first of all, stop listening to every stock tip in the market. Because social media and other online platforms try to encase this FOMO feeling by showing high returns and then give new stock tip that can create more wealth in quick time. Second, don't take any impulsive investment decision. Even if you identify a good company, try to spend some time and build conviction before investing. Now here, one of the risks is the stock might rise even further from your identified levels. So another approach is you can make a small entry and then in parallel continue your research, and once you are done with your study, you can take a call on further building your position or reducing it. And of course, keep a diversified portfolio. A lot of people end up investing a significant amount in a few high-risk stocks. This strategy can be fatal, especially when you invest without knowledge. Then another big problem with bull rally is unrealistic expectations. Majority of new investors that have started their journey post-COVID think that they can fetch 40-50% return in stock market every single year. I wish it was possible. But in that case, nobody would have invested in other asset classes. 40-50% return means your money doubling every 2 years. It reminds me one of the quote from late Mr. Rakesh Jhunjhunwala. If you are able to earn an 18% return on your portfolio, you are no less than a king. And if the return is 21%, you are an emperor. So 18 to 20% return from stock market is extraordinary. Very few investors could do that in the long run. And if you think that you can fetch even more than that, then it is a big mistake. Yes, in the short term, you can fetch a very high return in the bull rally, but that is not sustainable. Next problem with bull rally is people tend to ignore the fundamentals and valuations. Since even the fundamentally weak companies participate in the bull rally, new investors who do not understand the fundamentals and valuations end up investing in those manipulated stocks. And when the reality hits, majority of those weak companies tank 80-90%. Always remember that in stock market you can't ignore fundamentals and valuations. Even if you invest in fundamentally strong companies, you can't pay any price in the name of growth. Yes, it's not easy to learn this art of identifying fundamentally strong companies and figuring out the fair valuation. It will take a good few years, but learning that skill is the only way to create wealth in stock market on a sustainable basis. Then mistake number 4 is ignoring the large cap companies. During the bull rally, your mid cap, small cap and micro cap stocks rally much more than the large cap because of higher demand and obviously the smaller market cap and potentially higher growth rate than large cap. As a result, majority of people ignore the large cap because they don't get the excitement as there is no upper circuit and exponential return in large caps. The problem with this approach is that while everything looks great in bull rally, people forget that when the party gets over, those micro cap, small cap and mid cap stocks are the ones that would tank the most. And we have seen this multiple times in the past. Fundamentally strong large cap companies may not provide high growth to your portfolio, but they provide a much needed stability. And the stability is very important for long-term wealth creation. A lot of people say that they have a very high risk appetite and fine with investing only in small cap or micro cap, but in reality, they have not seen brutal corrections. Hence, they cannot comprehend the side effect of an extremely risky portfolio during the bull rally. Then fifth mistake is taking extreme decisions. In this bull market, I keep hearing some people sitting on 100% cash in anticipation of correction, while some people are 100% invested in anticipation of more upside. I think both the approaches are not completely right. First of all, there is no guarantee that the bull rally will end tomorrow. It may last for next few months, quarters or even a good few years. So sitting on 100% cash waiting for market to tank is a bad approach. In that case, you can miss out on big wealth creation opportunity. At the same time, you need to understand that market has already rallied a lot in last 3-4 years. So there can be profit booking in case of any negative news. So it's always good to have some 10-20% cash in hand that can be deployed systematically in case of correction. So the point here is take a balanced approach, build a diversified portfolio and remain invested for long-term wealth creation, but at the same time, it's good to keep some cash in hand during the bull rally. Folks, I don't want to unnecessarily stretch this video. The only message I want to pass on during this bull rally is enjoy the returns, but at the same time, keep a close eye on your investments. As long as you have built a solid foundation with fundamentally strong companies with a well-diversified portfolio, there's no need to worry. Yes, keep the expectations right. Try not to get too carried away with the FOMO in the market and keep learning the art of evaluating the fundamentals and valuations. Because fundamentals and valuations are the two aspects that would separate the winners from the losers in the stock market. Last thing I want to convey is always look at the long-term bigger picture. Yes, today valuations are stressed, but if you are holding strong companies, any correction will only create buying opportunity at lower levels because eventually Indian market is going to make newer highs in the years to come. And there's a lot of wealth creation opportunity if you keep your basics right and avoid some of the common mistakes made during the bull rally. Now tell me in the comments which is the most common mistake you have done in this bull rally. And let me know if you want me to discuss any specific sector or business fundamentals. I've recently done a lot of interesting videos that you can check out as well. And do share this video with those who have started their journey after COVID so that they can avoid these common mistakes. By the way, I also have a close community of long-term investors via weekly series where I share one exclusive video every week that include my top conviction ideas and stocks where I'm investing my own money. You can get the details on my website or via the join button. I'll see you next video. Till then, take care.